So Bismillahirrahmanirrahim. So today we'll continue from last time and finish the chapter 7 on how to reform financial institutions. So there are 4 reforms that are proposed. We've discussed this briefly last time, that improving underwriting, which is basically trying to make sure that the loans that you are giving can be paid back. As we discussed in the 90s, the idea emerged that underwriting was not necessary, and that is one of the major causes for the global financial crisis. Raising capital requirements means that asking banks to have more money in hand rather than a very small percentage. So increasing the margin of safety in some sense. Enhancing bank evaluations through greater use of the discount window means that basically monitoring much more carefully what the banks are doing. And micro and macroprudential regulations. Basically, micro regulation means that at the bank level, things that the banks are supposed to do, that's like in the Basel Accords, it puts some limits on how much risk the bank can take and how much money it should keep, and many other rules. And macro regulations refers to the system as a whole, so rules which govern the system, like putting limits on bank sizes and putting limits on the competition between banks. And many of these rules were made in the 1933 when US Congress passed some acts to regulate the industry. So for example, one rule was that no bank could operate across state lines, so they couldn't grow too much. That was in favor of local banks, community banks. And the Glass-Steagall Act and many others. So we look at all of these 4 items in detail. Basically, there is a fundamental objection to this system, the whole system of banking, and that is that the banks create money, and that doesn't seem to be fair. And the only way they can do it is because they have government backing. The central bank is there to bail them out, and there are many other rules and regulations which make this banking possible. So basically, the banking sector cannot exist without strong government support. So given that this system is there, in my own work, I have written a paper which is called the Islamic Iceland Plan, and basically after the Great Depression, a large number of leading economists, I think there are 150 of them, signed a paper which was called the Chicago Plan, and the Chicago Plan said that all banks should have 100% reserve banking. So the Chicago Plan was a system not just to go for this, but also how we can go from current fractional reserve to 100% reserve in stages. So they actually laid out the whole scheme and strategy and said that this is the only way to prevent this from happening. So this was part of those packages of reforms that were being done, but the financial lobby managed to defeat this one, unfortunately. So after the global financial crisis, this plan was revived in Iceland, and they made it more up to date according to current requirements. And but it's the same idea: how can we change the existing fractional reserve to 100% reserve? So a general theme which very few people are aware of is that you see, the problem with the banking is there are two problems. One is credit creation and the other is interest. Both of these are serious problems. Interest-based system, the defects of that are made very, very clear in Atif Mia and Amir Sufi's book, and it's purely written along secular lines. That is, it explains why interest rate is a harmful transaction, because it creates wrong types of incentives for people. So now all of the Islamic banking literature is about how to fix the interest rate problem, but they don't discuss the credit creation problem, which is the more serious problem in some sense. Now this Iceland plan, it's about the credit creation problem. It fixes that problem. It shows how to fix that problem, but doesn't address the interest rate. So I've written a paper which is called the Islamic Iceland plan, in which I've said if you combine both of these, then you get to something which could be genuinely called Islamic banking, and that would have the advantages. Currently people say that what is the point of Islamic banking, because it's just like interest-based banking, and there are many ways, many reasons why this is true. If you did both of those things, then you could get to an Islamic system. Anyway, the point here is that when the government is giving, and if you forget about the changing the system, within the current system the government is giving the power of credit creation, it should get something in return, and that thing is the underwriting, the ability to make safe and sound loans, which the government cannot do because the government is too distant. So the bank is local. So this is the kind of ideal public-private partnership. And this acts in the public interest in the sense that the banks are giving money, the government has authorized them to act on his behalf. That's the only way it is legitimate for the banks to create money. And even though actually the way it has worked really is that the government doesn't know about this. I mean, mostly it's by deception. The banks have taken this power, but suppose that it is well known, suppose that as it is, the 2014 paper by Bank of England says for the first time that what people believe about credit creation is not true. It is written in the textbooks that the banks do not create money, but actually they do. And the 2014 paper says that at the point that the bank makes the loan, money comes into existence at that time. Whereas if you read the textbooks, the textbook I read says that no, that's not true. The system as a whole creates money, but banks do not create money. So if the bank is creating money and it is guaranteed by the government, then the bank should be performing some service, and there is a service it can perform, which is that it can make sure that the loan is sound. So this is kind of a model. Now in the lead up to the global financial crisis, the idea became dominant that we can replace underwriting by these things. One is the credit rating system. So basically you have ratings, in fact you have international ratings where AA, AAA, B, C and so on. So all of the things, all of the loans that you are giving, bonds are given rating, and the low rated bonds are called junk bonds. highly rated bonds. So depending on the quality of the company which is issuing the bonds, the credit rating agencies tell you whether how much you can trust this bond. And in fact, one of the major causes of the global financial crisis was that there were these mortgage-backed securities, and they were given very high ratings when in fact they were very risky. So one of the things that you can do to replace underwriting is basically, what is underwriting? Underwriting is a kind of a guarantee that this loan is going to be good, that the person will. So so this is usually based on personal judgment and qualitative information. Now, the idea became prevalent that we can replace this personal judgment and qualitative information by an external evaluation. Just look at the papers and evaluate. So there should be a quantitative and numerical measure of the risk. And this idea is still dominant, the idea that you should have evidence-based policy and you should have quantitative goals, you should have SMART goals. All of these things are part of the dominant paradigm which is currently being used all over the world. And the problem is this paradigm is wrong. There are many important things which are not measurable. Like, see, if I have a relationship with a person, I can judge how reliable he is, but I cannot put a number on it, and no third party can come in and give a certificate. And even if they do, the reliability will not be according to the certification, because the reliability in a personal relationship is different from the one that is guaranteed by a certificate. And this also happened, that the certificate may be valid, the person may actually be reliable, but in a personal relationship and in an impersonal relationship, that might be something else. So this is actually a very important problem of the current period, that people are just too impressed by numbers and measurability, and they are disregarding. This is something which is a consequence of logical positivism, which is a philosophy which emerged in the early 20th century. That the only thing, basically, it's exactly the opposite of what the Quran says. The Quran starts out by saying, "Alladhina yu'minuna bil ghaib." It describes the mu'min as the one who believes in the unseen. So the logical positivism starts out by saying, "Alladhina yunkiruna bil ghaib." They reject the unseen. They say that if there is something cannot be measured, doesn't exist. So under the influence of that, psychologists started measuring everything, like IQ. Everybody knows, or at least they used to know, that intelligence cannot be measured. It's not something you can give a number to. People have intelligence is a multidimensional, complex quality which operates differently in different dimensions. Some people have street smarts, but they are not. So different people have different types of intelligence. You can't put a number on it. But under the influence of this idea that if it can't be measured, it doesn't exist, people started to try to measure these things. And these measurements are very biased and very culture sensitive. In fact, they did tests to show that the basically the SATs, they are very strongly culturally adapted. The questions they ask come from environments which will be familiar to the normal white middle class student in America, but they would not be familiar to the children growing up in Harlem. So actually they did a test of that. They took the same exact question and they revised it to put it into the cultural context which would be familiar to students coming from broken families and difficult segments. And they found that they could do them very well. and the other people had difficulty with that. So the point is that you cannot put numbers. The most important things cannot be measured. This is something which is almost clear, yani intuitively obvious to everybody. Like, for example, you want to measure the quality of research being done. So you cannot do it by counting the number of papers a person has written. And you cannot do it by counting the impact factor either. But under the influence of measurability, they did that. And once you do that, then people immediately start gaming the system. And that is what has happened. And whenever you put, because the numbers are actually a shadow of the reality. But if you say the numbers are real, then people start playing the numbers instead of focusing on the real. So the numbers are not meaningless. If a person is doing good research, he will be normally publishing and he will be normally getting impact factors. But this is a reflection of the world. This is not the reality. And this is exactly the main problem of logical positivism, that they mistook the observation for the thing which was underneath the observation. And this mistake continues to be made. Like in an illustration of this is in economics. They said, the preference of this, the preference of a person, what his heart desires is in the heart. That cannot be seen. So let's look at the choice. Choice is observable. So I put in front of the person a banana and an apple, and I ask him to choose, and whatever he chooses, that is the revealed preference. So this is again an illustration of logical positivism at work. The problem is, the choice is just a reflection. The preference is in the heart. The choice can be deviate from the preference for many reasons. I may like the banana, but I may be on a diet, and I may say that no, I can't have that, so I will take something which is less appealing to me, and many other reasons. So the choice is an imperfect reflection of the reality. Now the positivist says that the observable is all there is no reality. So then you get into deep trouble everywhere, like in the smart goals, like in measuring. You see, this is just an illustration. The underwriting is a measure in which I use my judgment to evaluate whether or not this person is going to be able to make payments. So in this judgment, there's lots of things involved, not just measurability. It's the character of the person, it's the nature of the neighborhood, it's the nature of the job, and so on. Many things are involved, but these cannot all be captured in numbers. But anyway, in the 90s, the impression arose that we can replace underwriting by these numbers. So that's one thing, credit rating. The other thing that was done was the credit default swap. This is a credit default swap is an interesting arrangement. So I have a mortgage. So now I have an incoming stream of payments that's going to be made to me. What I do is I go to a financial agent and I say that, all right, what we will do is I will pay you. I'm getting $1,000 every month, which is going to continue for 30 years. That's the promise. I will pay you 10% of this every month. So I am going to give you, I will keep 900 for myself, and you get 100 every month. In return for this, if my stream of payments stops coming, then you will have to pick up the responsibility. So if they default, then you pay. If they don't default, then I pay you. So this is a swap. We trade risks with each other. So on the one hand, I keep paying you, and if it goes through 30 years, he gets this 10%, and he has nothing to pay. But if at any point my mortgager stops paying his risk, then stops paying his mortgage, then the party with whom I have made the credit default swap, they start paying the mortgage, and I stop paying my, of course, 10% because I'm not getting the stream anymore. So this is a kind of an insurance. This is called a derivative. So now, once I do this, then I'm done. I don't need to do any underwriting because whatever happens, I'm covered. So I've already discussed this, that basically qualitative and personal relationships were replaced by quantitative and measurable techniques. Underwriting was replaced, and this is written in the book, that the idea that underwriting is unnecessary flowered and exploded. This became the dominant idea, and it was substituted by credit ratings and insurance. But it was discovered in the global financial crisis that this is not true. Credit ratings and insurance are not a substitute. Why? Well, one thing which factor is not mentioned is that numbers are not a substitute for reality. But the book says that the other thing is that these numbers can be manipulated, and that's exactly what happens when you say that, all right, the quality of your research is measured by the number of articles you write. So I was in a committee in HEC, and we were looking at this, and we found that there was a change. And people, before we started measuring the count, people were trying to get publications in higher quality journals of higher quality. After the count became important, then they substituted the quantity for quality, and they started publishing in low ranked journals where you can get easier publications more quickly, and they started concentrating on numbers instead of. So one of the problems that arose with the system is that there is a cutoff at the bottom. So there was a large increase of publications in the bottom ranked journals, which are the easiest to get into, and there was a decline in the top ranked because you want to focus on numbers, and that's the good strategy to do. So in fact, the idea that we considered, I don't know, I think it has not yet been implemented, although they were working on it, was to rank journals into blocks, A grade, B grade, C grade, and then evaluate them differently so as to avoid this problem. So you can manipulate the rankings. Of course, this is not this that I am talking about is not manipulation. It's just a clever substitution. Manipulation is when you actually start cheating, as these fraud journals do. They create journals which satisfy all the criteria on paper, but they are not actually legitimate journals. The referee process is just imitation of the real process, and they get impact factors by doing a lot of manipulation. And so similarly in underwriting in the USA, people started issuing these credit rankings which were actually fraud in order to get these mortgages to sell. So that's one of the things. But the other thing is also that there is something which is called moral hazard, which means that once I have insurance on the house, then I'm careless about allowing fires to happen. So the risk, even though it is correctly evaluated by the credit agency, it changes when you have insurance, because now you behave differently. So the past default rates become irrelevant. So you had experience going up to now of the behavior and use that experience to assess the risk. But after you issue these insurances and derivatives, then the person himself changes his behavior, because now what happens when you default is different from what was happening before. So the issue that is considered in the book that we are reading is that if private banks behave badly as they did, then why can't, basically the government is in the first place authorized to issue money, why can't they lend directly? So there should be a comparison between these two possibilities, that instead of relegating the power to create money to banks and then having them make bad loans, the government can make loans itself. So basically one of the keys is good underwriting, which the banks can do, which the government cannot do. If the banks are not doing this, then the justification for allowing the banks to create money disappears, and the evidence is that the large number of bad mortgages which were issued, the rates of default increased substantially in the period that we are talking about, when underwriting was replaced by these credit ratings and these default swaps. Similarly, the student loans is a very good example. Today now there is $1 trillion worth of student loans, which basically is a complicated issue, the student loan issue. Banks have an incentive to give a loan to anybody because the government guarantees them. So the whole incentive structure is misaligned. The colleges have an incentive to take in anybody because they make revenue from the tuition, and whether or not the student graduates, whether or not he gets a job, whether or not the education which is given is worth anything, all of these things don't matter. So there are lots of low quality institutionals which came up, and the students were deceived into taking loans to buy a bad education, and then ending up with degrees which were worth nothing in the market, and with a huge loan. So this is a little bit of a discussion of the particular situation in the USA, and it is worth discussing because this kind of thing happens. Basically, initially the government itself was giving loans to the students, which is the right mechanism. The banks intervened, and they said that, look, we are in the business of giving loans, why don't you just, instead of giving loans yourself, government should not do any business, which is, so we will give the loans, but you provide us with guarantees that the loans will be repaid. So this was accepted by the government. So basically the loans can be given by private banks. Then the many things happened. First of all, they colluded with the colleges to say that, okay, now you can charge anything you like because we can give loans for whatever the tuition is. So the college tuition rates increased very, very rapidly, much more than consumer price index, for example. And the students were told that, look, and this was advertised as making education available and affordable. Anybody who wants to can get a loan, at concessional rates which the government was providing, that there's no interest on the loans until you graduate, and after that the interest accumulates, but you don't have to pay until you have a job. So on the surface it seems quite favorable, but actually what happened and what has happened is that now there is a $1 trillion debt that the students owe. Basically the financial lobby captured all the students. All of the manpower in the US belongs now to the financial. Whenever they work, then they pay their loan. So they are slaves of the financial lobby. They work for it, and they have. So instead of this, why not the government give the loans directly? And in this particular case, the high default rate, if suppose that there is a default, suppose that students don't get jobs, this doesn't matter. I mean, the government is basically doing something which is in the public interest. So one of the things that MMT tells us is that if the government incurs a deficit by making bad loans on something which serves the public interest, it doesn't matter. The government could have actually paid for the whole education itself, and that's what happens in Europe, for example. The government provides free education, university education to all citizens, and this is quite sensible thing to do. So if it's giving loans and these loans default, that's still acceptable outcome. So one of the things that is mentioned here is that the government has a good collection service already, so giving loans is not a difficult problem for the student, for the government. So that was the discussion of the underwriting issue, which is complex. It's not, and for students, maybe you don't need any underwriting. You should just provide a loan to whoever asks for it, and because this is a social obligation to educate people. So the second orthodox idea about prudent banking, how to reform the banking system, is that you should increase capital requirements. And if you have banks have greater margin of cash in their pockets, this will make banking safer. But actually the Minsky thinks this is not true. Higher capital requirements were imposed after the savings and loan crisis occurred in the USA in 1980s, and after the MAB crisis, Mexico, Argentina, Brazil, in the 90s, the Basel agreements were, was it in the 80s? I think it was in the 80s. The Basel agreements were made in the aftermath of that, and they basically, one of the things they said was minimum capital requirements. But this didn't work when you look at the practice of what happened in the banking sector. You find that instead of playing by the rules in some sense, and instead of refraining from lending in risky loans, they found ways to move these loans off of the balance sheet so that they wouldn't be subject to Basel requirements. And there are many ways that they can do that. They could operate with a third party which was not subject. There was a huge shadow banking sector, so they could take the transaction out of their own books, or they could. There were many different ways, financial tricks and gimmicks that they could play, so as to bypass the requirement. So it didn't seem to have the effect that was desired. So one of the things that I would like you to understand, you are going to be facing difficult interview questions, is that the comparative advantage that you have is knowledge of history. This is something which is not taught to anybody. So any time you are in trouble in terms of somebody asks you what is an isochromatics curve, you ask, well, let us look at how this applies to the global financial crisis. Now the other party will automatically be in trouble because they don't know history, and that's something that you have to. And so when you start doing the analysis about how this applies, well, do you think that the equilibrium changed? Obviously there was a big jump in unemployment after. So what exactly happened? Was the liquidity LM relationship disturbed? Was the IS relationship disturbed? So that is something that you can discuss, which the conventionally trained economists cannot. And one thing is that if you are interviewed by somebody who's not an economist, then you are in golden, because non-economists will be very impressed by your knowledge of history and your ability to explain. And this will make you stand out over people who have not had, because the conventionally trained economists do not know anything about the Great Depression, because that's not part of, because again that's part of the methodology of economics as it was evolved. They said that economists think that their subject is a science. It studies universal laws. So what are the laws which operate? So the laws are not history bound, they are not time bound. So if you look at how the global financial crisis happened, the banks did this and the Basel Accord was this. This is particular events. There is no universal law here. So this is not economics according to the standard methodology. So the Basel Agreement also introduces okay, so what should the capital requirements be? They said that, well, there are different types of risk classes. So for example, if you buy treasury bonds, it's practically risk free, so your capital requirement on that is very low. And if you buy junk bonds, then your capital requirement is high. And if you buy A-rated bonds, then you have moderate capital requirement, and so on. So there are different types of risk classes, and the idea of the risk-weighted requirements was that the banks have a certain amount of reserves to work with, and so if they are going to tie up more of them in the risky assets, then they would not make risky transactions. First of all, this is wrong in two ways, because banks can acquire capital, so that's the capital they have does not actually constrain their activities, but even if they do undertake risk, having more capital around would mean that they would be better positioned to handle the losses. So this was the idea, but again this does not work as people think it would. So one of the problems was gaming the system as usual. When you try to quantify and put measurable factors, then immediately you start gaming the system. So what they would do was there were these mortgage-backed securities, and they managed to get them. First of all, if you have a risk ranking, that there is all of these assets in particular risk class and they have a capital requirement, then you can try to take the worst one in that one. Just like if you have a requirement for publications, you can take the bottom journals in a particular category. So that's one aspect of gaming the system. But even more tricky, these mortgage-backed securities were basically, first of all, you take a collection of this whole, every mortgage is paying a certain amount, so this whole is bundled into a security and say, okay, I have these 1,000 mortgages and my security is worth so much. This is going to pay $1 million every month with 1,000 different mortgages. The idea came from some economist. The economist said that, why don't, he had some brilliant idea, I forgot the name, but it is available, because he was very proudly boasting about how his idea has transformed the industry, and then he was hiding under the blankets after the crisis took place, because it was precisely this idea that caused the collapse. And the idea was that each mortgage has an idiosyncratic risk, but if you take a lot of them together, the average risk will be much lower. So you can basically count on a much more reliable. That statistically, this is true, that if you have independent risks, but the crucial thing that failed was that the risk was not independent. So all of the mortgages collapsed at the same time. This is something which could not happen according to the idea that they are all independent streams. And so the risk is protected if they are independent, but it is not if they are not independent. So anyway, this idea failed big. The theory doesn't apply. So what happened was very tricky manipulations were done in these mortgage-backed securities. They created very complex packages in order to get very high credit ratings. So you have all of these mortgages, and the mortgages have different qualities. So some, for example, if you have a mortgage which is the value of the house is 100,000 and the amount of the mortgage left is only 20,000, then you have 5 times the amount lying around in a house. So mortgage is very safe. And if you have a 90,000 loan on a 100,000 house, the same mortgage is not so safe. And there are many other ways you can change the credit rating. So what they did was they broke the mortgage-backed securities into tranches. So the top tranche would be the really high-quality mortgages, and then there was a second tranche and third tranche. And they structured the loans so that if there is a default of the security, the top tranche would get paid. So by complex manipulations, which I can't explain the full details of, they managed to make it so that the evaluation of the mortgage, the whole security was done on the basis of the top tranche, which was as safe as treasury bills. So these mortgage-backed securities were ranked at AA. They worked with the rating agencies to make sure to design the security in such a way that it would get a very high ranking, even though at the bottom there were very risky mortgages involved. It's just like, the fruit seller, he puts the best fruit on top and underneath there are rotten fruits. So it's exactly like that. They packaged these mortgage-backed securities and they got the highest rankings, and then they were able to sell these in the markets at the same with the ranking that said that it is just as safe as a US government treasury bill, even though it was highly unsafe, as transpired later. So these were called liar loans later. That they claim to be something, but they are actually something else. Second problem that rises with the high capital requirements is that the return on equity of the banks becomes lower. Because basically the bank's performance is evaluated by looking at how much money you have and how much return you are getting. So if the bank is holding, suppose you have a bank which has 10% capital requirement, another one which has 50% capital requirement. So, and both have the 10% requirement is using 90% leverage, and the 50% requirement is using 50% leverage. So they both have $100 worth of investment, but one is holding only $10 and the other one has $50. So now suppose both of them make 10% return. That is, on the $100 that you have invested, you get $10 back. So then the return on equity on the 90% leverage is 100% because you had $10 and you made $10. And the return on equity on the $50 is only 20%. You had $50 and you made $10 on it. So the performance of the bank with the higher returns is very poor relative to the high leverage bank. So because of this, if the higher capital requirements become binding, then the banks will try to move into riskier investments to increase their returns, because you can get more return if you have higher risk. So the idea of imposing a high capital requirement, making banks more safe, which actually work in the opposite way, it will make them less safe. So instead of this, Minsky recommends that you should have direct credit controls. You should control the type of loans that the banks is making, and you should make sure that they are not making too many risky loans. So basically, one of the key recommendations of Minsky is that you should force all the banks and the shadow banks to come to the discount window. Instead of borrowing from each other, the interbank market should be eliminated. You should read up on the LIBOR controversy for yourself. There was a famous scandal about how the banks cheated by manipulating the interest rates in the London interbank overnight borrowing. By manipulating those rates, they made millions and billions of dollars. So when the banks are playing the game among themselves, they can cheat the public. So instead of they should not be allowed to borrow from each other. They should all be forced to come to the Federal Reserve. And basically, if the banks are borrowing from the Federal Reserve, then the bank will have the right to examine their assets. And this is exactly like the bank. When the banks make loans, then they examine the assets against which they are lending. So the Federal Reserve Bank can also do the same thing, and that's the only method to prevent risky lending. It cannot be done indirectly by setting up some rules and some regulations. This is the key insight. By setting up some numbers to look at that you can examine. You have to do it directly. So one of the things that is used, again, technical terminology, is a haircut. The bank comes in and says that I want to borrow money and this is my asset. The asset can be a loan that it has made. So the loans that it has made are of different types. Some are risky, some are not. So basically a haircut is how much money, and basically the A grade loans like the treasury bills that the bank already has, it can borrow against it can borrow up to 100% of the value of it. But if the loan is risky, you can borrow 90% or 80% or 70%. So that's called a haircut. So by implementing the right kind of haircuts, you can create the structures which will prevent. So this is instead of the margin requirements, which are the sort of indirect controls. The direct controls are that you can borrow less on risky loans, so the bank will be able to. So you are basically going to discourage borrowing on the more risky loans. Now, actually, what the these are Minsky's recommendations on how to reform. What actually the practice was the opposite of this. The banks were operating on the wrong macro theories, and the macro theories said that the central bank works by controlling the level of reserves in the economy. And so basically, the open market operations is how the bank controls the reserves. So what are open market operations? The bank buys bonds in order to inject money into the economy, and it sells the treasury bonds, treasury bills to mop up and reduce the amount of the money supply in the economy. So the reserves do not matter, and actually since the banks have started controlling the discount rates, so they cannot even control the reserves, because in order to maintain the discount rate at a certain level, they have to buy and sell bonds according to whatever the market needs to keep the rate at that level. So they cannot even control the amount of reserves, but controlling the reserves is really not relevant, because what is relevant is controlling the loans, and the only way to do that is to actually directly examine the loans, as we have been saying, and that means that forcing the bank to come to the Federal Reserve Bank to borrow and eliminating the interbank borrowing market. So in the 90s, there was a move to reduce the regulatory powers of the Federal Reserve, to give it less oversight, and to basically all of this was based on the wrong theories about money and the wrong theories about how the economy works. So basically, central banks do not control the supply of reserves because they are managing the interest rate. Reserves do not determine the supply of money because money is endogenously created, not exogenously. So after the global financial crisis, it became quite clear that we need both microprudential and macroprudential regulations. So microprudential are what the bank should be doing. But it became clear that the failure was not at the bank level, it was a system-wide failure. And there were failings which, even if all the banks follow the same practice, we need to make changes in the system. What Minsky says, again, this is looking at the empirical experience, and this is the big difference between what we are doing and what conventional macro does, is that the conventional macro is based only looking at symbols on the piece of paper without ever looking at what happens in the real world. So what Minsky said is, if you look at what has been happening, after each crisis, people go and say that the Federal Reserve should do X, Y, and Z. So the failure is always one of needing more regulation rather than needing less regulation. The Fed doesn't fail downward. It was not because of regulation that the crisis happened. It was because of lack of regulation that the crisis happened. So the empirical experience shows that we need more regulation and not less regulation. And also the Great Depression shows that very clearly, that unregulated banks led to the crisis. Then in 1933, very strong and strict regulations were put into place, and for 50 years there was no banking crisis. And then deregulation started in the Reagan-Thatcher era, and again we are having hundreds of banking crises. So basically the thinking cap coming from Chicago school is that the government is always an obstacle, regulations are always bad, the free market will always achieve best results. So the only thing that can be done in a post crisis. Of course, it became obvious to everybody that banks are doing risky practices, so some regulation is needed. But again, micro-regulation is needed. But after the global financial crisis, there was some. This is called microprudential regulation. The bank should have better regulations, but it became clear that we need macroprudential. We need system-wide reforms. If you look again at the empirical experience, you find that in the savings and loan crisis, we had both micro factors and macro factors. Deregulation allowed the banks to do a lot of risky things which they were prohibited from doing in the past. So the deregulation definitely played a role, but also the high interest rate policy of Volcker put the whole industry at risk. Again, this is something which I understood for the first time here after realizing it is. See, if you look at the intermediation theory, which is what I had been trained on, then I couldn't understand. See, if you have money and you loan it at low interest rate, and then later the central bank raises the interest rate, so what does it matter? I mean, yes, you're getting less profits than you would have, but it doesn't put you at risk. But if you loaned the money which you didn't have and you keep borrowing it to service it, then when you raise the risk, then you are at risk, because now the loan you have made is at low risk and you're borrowing at high interest to cover the loan that on money that you never had in the first place. So the financial intermediation theory is shown to be wrong by this. Also, the global globalization was taking place, and there was a lot more deregulation. Even in Pakistan, the rupee was made convertible over this period of time in 1980s, I think, sometime. So over this period of time, globalization. So there was much more easy to flow in and out, and actually the savings and loans, basically the returns are larger in emerging markets, and also the risks are larger. The savings and loan banks went into Mexican loans in a big way because they were paying off, and then later the Mexican peso crisis caused a huge problem. There was a huge collapse in Russian bonds also. So as usual, because of the way the incentives are structured in the banks, they create this money and they don't pay anything if they lose the gambles, and they get gains if they win. So the banks have all the incentive to take risky gambles, and this was done. So there was a real estate and housing bubble taking place in 1980s in the USA, which was caused by, there was a local oil boom, and so this also led to expansionary policies which were not prudent. So once the crisis took place, the government actually bailed out to a massive extent. I put recently a book on your library called Inside Job by Pizzo, Fritter and Muolo, and they have another book on the global financial crisis. This is really worth reading. It provides you the inside story of how the crisis happened. One thing that I'll make a little bit later, is that these are the trees. You need to know the details, but you also need to know the theories. So we are operating at a macro level, why this happened, and on a larger level, which doesn't have to do with how the director of a bank was corrupt and he was cheating the public. This also happened, but there were some bigger factors which which basically made such behavior possible and likely. So the bigger picture is also important. Although you see, if you look at the small picture, you say, oh, there was one corrupt person, or there were 1,000 corrupt people and they caused the crisis. So then you don't understand the bigger picture. So that's what Minsky is saying, that you need to look at the system-wide risks and the interrelationships between what is happening here and there. And that is only the macro picture. So the microprudential regulation, making sure that people don't cheat in the banks, is not going to fix the problem, even though it might seem like it, that that's what's happening. So that was what's happening in the 1980s, but things are far more complicated in 2000. There were these extremely complex derivatives which even the most sophisticated of the traders said that I can't understand what this derivative is, what it's doing. There was people were taking insurance. When you take an insurance, you have something which is called a counterparty risk. That is, the person who is insuring you, are they reliable? Are they insured? So actually, technically on paper, everything was good because the insured party also gets what's called reinsurance. So if they collapse, but these were all basically interlinked. So if I insure you and you insure me, then we are then this is a circular. So if one party collapses, then both parties will collapse. So there was this huge chain of relationships. Nobody could understand, is this person really insured, or is it coming back to eventually he's insuring himself by buying insurance from X, from Y, from Z, and then it comes back to him. So ultimately he's insuring himself, and means that it's not insured at all. So there were major defaults by the biggest insurance company, and there was a major bailout by the US government. So microprudential is not enough to identify the system-wide risk. If people are cheating the system by offering insurance to each other, which makes them look safe, and then using this to sell, so two big parties insure each other, and they say, look, I'm perfectly safe. If I collapse, the other party is going to insure me. So you can buy my bond, so they can sell things at a high price, when in reality, so somebody needs to be looking at the big picture to understand that this is going on. Looking at one bank by itself will not reveal to you this risk. However, Minsky says that just putting rules, macroprudential, is not going to be enough, because the system continuously evolves and they will be trying to outplay the rules and outgame the system. So what you need is dynamic micro and macroprudential regulations. You need a central bank which has its finger on the pulse. It keeps watching and monitoring, and it keeps looking at the new developments, and it keeps devising policies in light of the new developments. So effective regulations must be reassessed frequently and made consistent with evolving market and financial structures. So you need dynamically to update the regulations. Central banks need to keep close watch on the banking sector. And how can they do that if a large sector like the shadow banking sector is completely out of the control? Well, all banking type institutions need to be bailed out from time to time. The shadow banks use the interbank borrowing to make them going. Normally, basically, actually what has happened is that the banks set up their own shadow banks in order to be able to operate outside regulations. So, and then they bail them out. So all institutions should be directly responsible to the central bank, whether it's a conventional bank or whether it's shadow bank, and that's the only way to make sure that there is a regulation that's going on. All right, around this time in 2010 there was or 11, maybe 13, there was a conference in Bali in which they asked me to present a paper on Islamic macroprudential regulations, and I have a paper which is available in a talk which I will send you a link to. It's already linked on the page, and have a look at that. That is Basically, I say that in Islamic regulation, unlike Western regulation, we look at three pillars. We look at the character and morals and ethics, which is something which is, and we work on that. And also we have institutions, and also we have laws. So there are three different things. And in all of these, Islam offers genuine innovations which are not currently in existence in the West, and they are genuinely valuable. And in the wake of after the global financial crisis, many people realized this, and there was this article in a French journal, Le Monde, I think, that the Quran offers us better guidance as to what went wrong and how to fix it than the Pope. So there is, Islamic rules on finance are very sophisticated. It can be considered as a miracle that 1400 years ago rules were made which are directly applicable to what happened in 2007. And if these rules had been in place, the crisis would not have occurred. All right, so